Welcome back. I'm going to have the opportunity and privilege and pleasure now to talk building rural wealth. This morning, Kaleb Roebuck. Kaleb, how are you?
Hey, good morning, Aaron. I think that's 3 weeks in a row you've nailed it.
I get there. It takes so. Let's not brag too much. I might mess
All right,
it
I
up
don't
before our
jinx you.
conversation is over. And also, so Kaleb, how are things going? Going well?
Good, yeah. Great Memorial Day. We are closed today. Office is closed today,
Yep.
this Memorial Day, but we'll be back open Tuesday. But yeah, good day to remember everybody that served and good
Absolutely.
Memorial Day. So
You bet. And Amy Shipley with me. Amy, how are you?
Hi, good, Aaron. Thanks.
It's been a while since we've had the
it
opportunity
has
to
been a
visit.
little while. I'm still around though.
You're doing well.
Doing well.
Like
Yep.
the new office?
Love the new office.
Isn't it nice?
Yeah, it's a really beautiful space.
Yeah.
Yeah, has
Cool.
that new smell.
Yeah. I love it. I love it. So, risk tolerance and why it matters. Okay, Kaleb, what are we talking about here?
yeah, well, when you talk about risk tolerance, when we were talking about it before the show a little bit of what does that actually mean, and everybody does kind of have their own term or definition, or for a lot of people it kind of feels like a technical term that only applies to your investments and stuff, but it is something that is one of the more personal aspects of your financial life. But for a lot of people, they don't know what it is, how to define it, like what it means for them. And most people just think it's about being conservative or aggressive, but to us there's a lot more to that and what it entails. So today we wanted to talk about that and kind of break it down and tell folks what is our process and what does it mean for the end client.
Give me a simple definition of what's risk tolerance.
Yeah, simply, risk tolerance, to us, or if you look it up in the Webster's dictionary, is, your risk tolerance is your personal comfort level with ups and downs in your portfolio or the stock market, especially during uncertain or volatile times. So, again, most people perceive risk of, every day's risky and stuff like that, but we're really kind of focusing it to your portfolio risk, your investment risk, and how do you define that? And a lot of things of what risk tolerance is, it's not just your personality trait, that plays into it, but most people think of their personality trait as their risk. Well, that's blurring the lines a little bit between your personal and your investing risk score. It's also not a measure of how much money somebody has. Your risk score might be influenced by your amount of assets and stuff, but it really should be looked at, regardless of what your portfolio value is. And it's not permanent. Your risk tolerance does change with age, with time, with, certain circumstances with you personally. Mm-hmm. But, hopefully it's not something that changes with just the market whims.
So, Amy, talk to me about some of the dimensions: risk tolerance, emotional, risk capacity, financial, and the risk required. This is more strategic. So let's start with risk tolerance, the emotional component.
Sure.
component
Well,
of it.
like Kaleb mentioned, your risk tolerance is kind of your gut response to market volatility. It's how you feel during a downturn. Or do you panic? Do you wait it out? Do you buy more? Your risk capacity is what your financial situation can handle. It's based on things like your time horizon, your income sources, how much cash you have in reserve. For example, capacity-wise, a 35-year-old business owner and a 72-year-old widow may have very different capacities, even if they feel the same way about market swings.
Very true. And the strategic portion.
Sure.
Amy.
Well, that's the level of risk that you need to reach your goals. So if you want to retire in 10 years and maintain your lifestyle, we'll look at whether your current path will get you there and what kind of return might be needed.
Okay. So why is it important to understand those three?
Well, all three need to be in sync. So you might be comfortable with risk, but your timeline might not support it, or vice versa.
Yeah, and this is why it's so hard for people, because those three dimensions Amy mentioned, most people, again, they're not trained to answer that question. They're not in the markets every day. They're not trained to set out their goals and how that relates to their investments. But it is kind of triangulating those three dimensions. Our process, or how you get there, is by asking those discovery questions. What is your most important? What is most important to you financially? For most people, they got their retirement accounts, but then they might have a savings account that's for their house in 3 to 5 years, a college account. So even some of those buckets are knowing, hey, what is that portion of money for, helps determine that risk score. You got to ask the questions to the end client. What is important to you? Let's actually define it on a scale of 1 to 99. What is your risk? but also understanding, that's going to change and evolve with.
Let's talk about some real life examples, Amy. So,
Sure.
a farmer near retirement.
Okay. And does a farmer ever get near retirement?
No,
Really?
I don't know.
I know. Well,
Yeah.
they do eventually maybe slow down, but I don't
Yes.
think they ever retire.
No.
So for our first example, the farmer near retirement, they may have a high net worth, but they want stability. So they have a low risk tolerance because they're near retirement, a moderate capacity because they've got quite a bit of net worth, and their needs are low required risk.
Let's talk about a young couple that's inheriting land.
Okay, well, they would have maybe lower investment experience and a moderate timeline. So their risk tolerance may be low, but they have a long-term capacity. So they've got a long time horizon.
Okay. They can make some mistakes here and there and have a market up and down, and they'll be fine.
Right.
Okay. And these are all things that you assess with people, right? When they come in and sit down and talk about.
Yeah, we
Yeah.
feel it's really important.
Yeah.
I mean, and we highlight that at every meeting that we have with our clients. What is your risk right now? This is what your portfolio looks like. What are your future plans? And is that, risk score matching up with those expectations?
Well, like Amy said, a lot of those examples, they're kind of competing sometimes. Hey, they got a long time horizon, but they got low risk capacity or risk tolerance and stuff. So that is kind of, to us, part of that balance of how do you figure that out? Because at the end of the day, we're stewards of the money. We got to help people place it and do it, but they got to stick with the plan that's in place. So there has to be that level of comfort. But a lot of times when you're first having these initial conversations, you do find, hey, they're kind of competing interests. Again, I want to grow as much money as possible, but I want it as safe as possible and no risk.
Yes.
We all want high returns, no risk, and no volatility, and be able to pull it out tomorrow. But in investment world, again, those are competing things, and how do you do that? So it is very conversational at first, and finding those things, and then kind of pinpoint.
Kind of have to find that balance, right?
Yeah.
Between
Well,
all of
and
those.
our philosophy is you need to find that balance before we ever invest $1 for anybody, because that is the critical part of, that's the whole basis of how you build a portfolio and how you're going to manage it and stick with it and have that conversation going forward with a client.